Holy smokes, everyone. This is the moment we've all been waiting for, the event of the evening. Every single stock market indicator that says we are overvalued and every single sell indicator is flashing code red and is at all-time highs. In this video, I'm going to be going over all the indicators that are flashing red, telling us that the stock market is overvalued, and I'm going to be going over the latest report from Morgan Stanley that goes in depth and tells us throughout history of what indicators have actually predicted previous market crashes and what we need to be looking at in the markets right now. Because what's happening in the markets right now is we are at an inflection point. We're at a turning point in the markets. We had the stimulus that lifted the market over the past year. We had Jerome money print to go burr that lifted the markets. We had the M2 money supply increasing. We had the $1,400 stimulus checks. So the government and the Fed was making it rain with all the stimulus. But unfortunately, now there's no more stimulus checks. There's going to be higher taxes, and the Federal Reserve is starting to slow down its purchases of treasuries, and they also said they're going to start dumping some corporate bonds. Okay, everyone, let's not waste any more time. Let's hit the charts. Okay, everyone, so looky here. We took out the June 2007 highs. Morgan Stanley's sell signal just hit an all-time high. And when you think back to 2007, I think something pretty bad happened after 2007. What was that again? Oh yeah, that's right. The global financial crisis. The crash to rule all crashes. The crash which led to the Great Recession. So we better listen up here, everyone. Listen to this. For the past several months, Morgan Stanley fundamental analysis have been turning increasingly bearish on stocks, with pessimistic sentiment plateauing earlier this week when chief equity strategist Michael Wilson said there is far too much optimism in the market, and that while earnings are slowly rising, forward PE multiples are far too high and are set to slide. So what it's pretty much saying there is he's saying future earnings are going to be a lot less than what the markets are saying now, because company earnings have been great from all the stimulus checks, people have money to spend, but now that stimulus is being taken away, companies' earnings are going to drop in the future. And what you have to know about the stock market is many people think that what's happening now will affect the stock price today. But stock prices today are what the markets priced in 6 to 12 months ago, because the stock markets are always forward looking and they price in events before it happens. For example, if the market thinks interest rates are going up, they'll start to sell off. Like we've kind of had a little bit of a sell off in the NASDAQ with the high growth tech stocks, is because those are the markets trying to predict that the Fed will lift interest rates sooner than expected. As a result, in Wilson's view, which is rapidly emerging as the most bearish on Wall Street, earnings revisions will not be able to offset that derating, leaving the overall market vulnerable to a 10 to 15% correction just in the next 6 months. Now, I know you may be thinking here, another bear, a bear that's predicted, 1,000 of the last 3 crashes, here we go again. But people, what you have to know is there's so much complacency and so much over optimism in the markets, and there's so much cockiness, like, there's no stock market's not going to crash. Jerome, he's going to come with money printer, he's going to, prop the stock market up again. But remember what happened in 2018 when you think the Fed's always on the market side. It actually crashed the markets in 2018 when it started to lift interest rates. So even though the Fed's been on our side now because last year, the markets completely collapsed, the money markets dried up, the Fed really just did that to save the financial system and provide liquidity. But at the end of the day, the Fed doesn't really care what happens to the stock market as long as it doesn't affect the functioning of the financial system. So it now appears that Morgan Stanley's fundamental bearishness has spilled over into the bank's technical analysis team. And as the bank's chief Euro equity strategist Matthew Garman writes, for only the 5th time in over 30 years, each of Morgan Stanley's 5 market timing indicators are giving us a sell signal at the same time. So people, even though we haven't had a crash yet, and even though it seems like, stocks only go up, they're only going to the moon, this is crazy. All of their sell signals are flashing red, and this has only happened 5 times over the past 30 years. So this is something we definitely have to take into account and listen to here. Not only that, but the bank's combined market timing indicator, which has been in sell territory since March, just hit a new all-time high of 1.19, surpassing the previous high seen in June 2007, right around the time of the first great quant crash and before the markets collapsed. This combined market timing indicator is higher than it was in 2007. So I hope this just rings some alarm bells in your head and kind of just wakes you up, wakey that it is possible that we could see a severe market correction. But let's keep reading. According to Garmin, the only time equities have risen after a full house, we've got a full house here, sell signal, was in Feb 2017, shortly after Shanghai Accord kicked in to prevent a global recession. The other previous occasions where there was a full house sell signal were March 90, 92, and 07. According to MS, in the 6-month post the initial full house sell signal, the MSCI Europe has fallen on average 6%. Okay, but I don't think this might be convincing enough. We need more proof, more data that things are looking very grim. So it's not just the bank sell signal that is promoting concerns about future returns of cyclicals, that's cyclical stocks, so stocks that perform well in boom times, but also those stocks perform badly in recession times or times where incomes drop and people's savings and spending drops. So Morgan Stanley looks at the number of Chinese data points which are giving warning signs. First and foremost, the collapse in China's credit impulse, which just turned negative. So China is one of the biggest economies in the world, second only to the US. So they're the ones that do a lot of investing, they do a lot of spending in the global economy. So if their credit dries up, then that's going to be a lot less investment in the US and in Australia. So it says here, you have to ask yourself if what is coming is an analog of one of the only episodes in history where the market did not plunge after Morgan Stanley market timing indicators hit a sell and were at all-time high, or will this be a case similar to 90, 92, and 07 where the outcome was anything but a happy ending and it was much more than just a little correction? It was a full-blown market meltdown. So those are just some of the sell indicators from Morgan Stanley. But it's not just these indicators. There are more indicators which I'm going to go over, which could have even more devastating events for the stock market. So looky here, everyone. This is the proposal Joe Biden has for the rich and for the markets. And this is something I don't think the markets are pricing in. They're not taking it seriously. And I think this is something people completely overlooking. So let's have a look here on what his proposals are. So number one, the top individual federal income tax would increase from 37% to 39.6%. The corporate tax rate will increase from 21% to 28%, as well as a minimum global tax rate of 15%. So that's going to hurt companies' earnings even more. Taxpayers with incomes over 1 million would also pay a tax of 43.4% on capital gains. And the step up in basis on death and carried interest loopholes would be eliminated. So people wouldn't be able to hold on to those assets and pass them on to, their children when they pass away and avoid paying taxes. They're going to tax you when you earn income. They're going to tax you when you invest. And then when you die, they're going to tax you again. And also caps would limit tax deferral for real estate exchanges and deductions for excess business losses. So what that means is the rich are going to have much less take-home pay because they're going to have much higher taxes, whether you agree with it or not. But all I'm just going to go into is how it's going to affect the markets. Say, for example, if they had a capital gain of $1 million before, and before they only got taxed 20%, they have $800,000 to pump up the market. Where now they're only going to have $570,000 or $560,000 left over after making a capital gain of $1 million. So there's going to be less money being able to go in there to keep the market going up. And also what this could lead to with higher taxes is a lost decade along with higher interest rates and lower company earnings. But the man, the myth, the legend, Warren Buffett, his indicator is flashing code red, extremely overvalued. The Warren Buffett indicator is now 230% of GDP. Now, overvalued would be, anywhere between 40% of over GDP. Strongly overvalued is 80% over GDP. We're at 230%. The stock market is 230% of the US gross domestic product. And also the S&P 500 PE ratio. This is where it tells you what a company's stock price is compared to its earnings. And there was a short-term glitch, in 2009 when, the PE ratio went to like 120 odd percent. So we can't really include that there, but it is now higher than what it was in the dot-com bubble. It's at 44.95 and rising. The S&P 500 dividend yield is nearly at an all-time low of just 1.36%. You can see here, normally the average was around 5 to 6%. And margin debt is at all-time highs. And why this is so important is because first you get the institutions put in their money, retail investors put in their money, then the institutions borrow margin, then the retail investors borrow margin. But once all the money's in, and once everyone's leveraged to the max, once they've maxed out their credit, where's all the other money going to come from to lift up the markets? There's no more money to go into the markets because it's already all in. And the Federal Reserve's balance sheet, this has been the narrative of why, the stock market is going to skyrocket, is because, money printer went burr. We can see here in March 2020, I'll just bring this up here, the Fed's balance sheet went completely parabolic. It increased from around 4 trillion to 7 trillion just in 3 months. So obviously the markets were going to skyrocket then. But now, over the past 6 months, we're just kind of having a steady increase here. They're not really going parabolic anymore. And like I said, the markets price in events before they happen. So they've already priced in the money printer go burr indicator. And of course, like I said in my earlier video, the Fed is set to sell corporate bonds. This is a form of tapering, which is bad for the markets. The markets don't like it when the Fed taper. And as you can see here, as I'm recording this, the Dow is down just very slightly. It's just very red, but the markets doesn't have to seem like it's going in any clear direction. It goes up 1% one day, then down 1%. The markets kind of don't seem to know where to go from here. And I think what we're in is the calm before the storm. And just to put it all in perspective, every single indicator that has predicted every bubble in history is screaming code red right now. It is flashing at us, telling us in a bubble. Look at this. Obviously here in the S&P 500 in 2000, when we look back, everyone, when you tell them about the dot-com bubble, they go, oh yeah, dot-com bubble. All those people were so stupid investing in the dot-com bubble. It was so obvious we were in a bubble. I can't believe they invested. Well, look at where we are now. And all the indicators, all the price to earnings ratio, etc., they're all higher than here. So why is it not obvious that we're in a crazy bubble and that a big correction is going to come? We can't know exactly when it's going to come. We might have to be patient. It may take a while because markets can be irrational. They say longer than you can be insolvent. But this doesn't mean we get complacent, and it doesn't mean it's not going to come, because history doesn't always repeat, but it often rhymes. And again, in 2007, people are like, so obvious that, we're in a bubble in 2007. It was so obvious the market was going to crash. Well, again, look where we are today. Why is it not obvious now? So everyone, that's just some of my thoughts and opinions on where we are in the stock market at the moment. Again, I'm not saying the stock market is going to plummet tomorrow, next week, next month. Nobody can predict the market. But we can get a rough idea of where we're in at the market. And we significantly overvalued. We are due for a correction at some point. So all I ask you is to take this information into consideration. Don't over leverage. Don't make crazy speculative bets, thinking that the market's going to double again next year, because I do think we're going to have a lot of slow growth, and it's even possible that we enter into a double dip recession. Now, for all my loyal viewers and subscribers still watching, you're awesome. I just want to say thank you to all my loyal subscribers, all my loyal followers. You guys are awesome. I'm loving pumping out this content and chatting with you in the comment sections. We've got a great community here, and I'm just grateful for you all. And if you haven't already, please tap that like and subscribe button. I'll keep you all up to date on the latest happening in the stock market, housing market, and global finance news. If you're bored, I'll put up some other videos here. I'll see you all there.